Now, I always like to read from Bill Gross. He has a flair for language. He said most recently here, sovereign bond yields at record lows are not worth the risk and are therefore not at the top of my shopping list. It is too risky. What is Bill Gross saying in his most recent note?
Well, I think, look, it's been a concern for years that yields have been too low and that they're bound for some kind of correction where yields rise, prices go down, people lose a lot of money. Basically, the lower yields go, the more and the longer duration, the longer the maturities stretch out, the more you could lose at even the smallest increase of yield. Fitch put out a report today that if benchmark yields were to go back to the levels of in 2011, investors would lose $3.8 trillion. That's a lot of money. So, given the stakes, he sees more downside than upside. And he could be right. The only problem is, this has been the hardest bet to get right for years. It has been the pain trade. So it's very difficult to know how to position around that perspective.
What could cause rates to rise at this point when investors talk about the potential for rates going up? What could cause that to happen?
Well, let's look at what's happening in Japan.
Sure.
In the past 3 days, you've seen yields on benchmark rates really rise substantially. There was an auction of 10-year notes there that was the least bid for in 5 months. You are seeing a weakening of demand from foreign buyers for treasuries, not for corporates, but for treasuries here in the U.S., just based on the currency differential. Basically, they're having to pay too much to hedge against the dollar risk versus their currencies. It offsets any potential extra yield they would get by going into U.S. treasuries. If they don't come here, then you have to start looking at the fundamentals of the U.S. economy again, which don't seem to be quite as dire as the actual yields on treasuries right now are suggesting.
When Bill Gross casts his eye around the world, when he's looking at Europe, when he's looking at Japan, what he sees is a toolbox that essentially is empty. There's not much left in it. How widely shared is that view? Like every investor, Bill Gross gets some things right, he gets some things wrong. We'll be looking at his most recent record here. How has he been doing, and how widely shared are his beliefs?
Well, in the past month, he's in the 40th percentile, his Janus Unconstrained Bond Fund. In the past year, he's about 70th percentile, so he's doing okay. He's not at the absolute top of the pack, but his view is shared by some very big and respected bond investors, Jeff Gundlach among them, who has said, I would sell everything right now. He came out with his really dramatic statement he was quoted in the past few days. So, there is a rising level of concern. How sustainable is this when profits are declining, when you have growth slowing, when you have stimulus efforts that are not working and that are running out of steam? How long can this last? But at the same time, it's very hard to see what could reverse it. The only thing really that people point to is possibly inflation, or if some company or some country decides not to pay back their debt or just forgive it, or come up with some kind of engineering that creates a technical problem.
Just pulling up a chart here on my terminal for those who have a terminal at Bloomberg at home. It is 2254, hashtag BTV 2452. Excuse me, I got the number wrong there. Looking here just at that decline in yields. I mean, it is fairly dramatic. Just looking at that is rather dramatic. It's
tremendously dramatic. And should countries, that's the global sovereign yield index that is on the Bloomberg, and is that right? Should the average yield be 0.5 percentage points? You have a place like Spain that's struggling to get their government together that can borrow, to have a government that can borrow at 1%. 1%. That's amazing. So, does this make sense logically? No, but it hasn't made sense for a long time, and it's kept going.